Hey everyone, so I'm Michael Monskanian. Appreciate you guys coming out, hanging out with Eddie and everyone else out here. Owners Club people, so 2 people, like honestly, great seeing you guys. For anyone who's not a real estate investor, not in a real estate investing mentorship, I'm even more glad to see you guys because it's awesome that you're even in this room right now, just trying to learn and change your life, so it's awesome. Before we start, Eddie made such a phenomenal point about networking. You're here, you're with other people that want to do real estate, connect with each other, and if I can give you one huge piece of advice, something that's helped me scale so massively over the last couple of years, it's sharing what you're doing. So sharing what you're doing by like in person, but also sharing what you're doing on social media. So social media, I am not a social media guy, which is kind of hard for people to believe now because I do a little bit more of it. But I have seen the massive benefits of sharing online what you are doing, because that is how you get people that want to partner with you, bring you deals, people who have money who want to fund your deals. It's just how you get to connect and network with people that you're not physically or locally present with. It's the ultimate cheat code. It's a massive leverage tool, essentially. So with that being said, one thing I teach people to do is anytime you come to something like this, great. You're doing the good thing, you're here, you're present, you're taking notes, you're learning. The easiest thing you can do to create content and to share that with other people who might be interested is take a photo of what you're doing, share a takeaway, don't just share a photo of me standing up here, something that you learn, and then tag other people that you meet on your social media. I'm a cheat code, right? If you tag me, Michael MNAT, I'm going to share it. I don't have a huge following, but I'm going to put you in front of 5,000 other people that want to do creative finance or are doing creative finance, that want to do co-living or are doing co-living, that are my capital partners, want to be my capital partners, or will someday be my capital partners. So I will put you in front of those people. So when you do anything like this, don't just show up to Zoom calls, don't just show up to meetups. Capture the moment, share it to other people. That's how you're going to provide value to other people, and they will eventually reciprocate that value and maybe be your partner, team member, whatever. So that being said, let's get started. This is part of, I have my own little community called Super Investors, and it's really 3 key components. One of the biggest being we love our co-living deals. So this full training is all focused on co-living. If you are not already following me on social media, Instagram, Michael MNAT, if you want to follow me, please do so. But more importantly, I've got a bunch of free tools and resources that will help you with budgeting, personal finance, real estate, kind of everything under the sun. And it's all on my Instagram. So go for it, follow it. I'd appreciate it. All right, so with that being said, let's get started with the co-living masterclass. All right, so we're going to cover today. I'm an engineer by trade, so like I like PowerPoints. So we're going to really do this the regular PowerPoint way. So really briefly touch on the Super Investor cheat code, why co-living is the best rental strategy right now, and how to choose a market and property, as well as the cost to buy and own co-living properties. I wanted to essentially run you through everything that I think holds a lot of people up on taking the next step in their investing journey, whether you're starting, whether you're scaling, whatever your goal is. And it's hard because I've done a previous co-living training here, so I thought this would be a part 2, but there's a lot of new people here, so I gotta teach some of the basics probably. So with that, let's get started. Who am I? Why am I even talking here? So I have 2 businesses. I have Coast to Coast Tech, which is my real estate investing business, and then Super Investors, which is my community. I also, under my community, I have a bunch of free stuff. I've got like 1,800 members who get free courses, tools, all that education. My goal now that I've achieved financial freedom through real estate is to help other people do the same thing. I try to share and teach all the things I wish people taught me 7, 5+ years ago, all the things I had to learn through books and mentors and all that good stuff too. Shout out to Pace Morgan, the best mentor ever. But all the things that I wish someone kind of gave me more step-by-step roadmap, that's kind of what I try to provide people, for people. So, because Eddie butchered it, which is okay, it's Monskanian.
Close enough.
Close enough. I mean, it was close. It's Monskanian. I'm an engineer by trade. I'm an Army veteran, and the most important thing you can take away from my story is my family is my everything. I started with literally nothing. My family immigrated to America. I joined the military as a massive thank you for being born in this incredible country. Forever grateful for all the opportunities it provided me. And for me, it was always obvious I was going to be financially free. I didn't know how I was going to do it, but I knew that very early in my life I was going to do everything it took to be able to do whatever I wanted with my life. Essentially, I hated the concept of, for the next 40 years, I was going to have to ask for time off. I was going to have to, ask someone else if I could enjoy my life, my family, and I didn't want to do that. because that's how I was raised. With my mom who worked multiple jobs, barely making ends meet. So what I'm going to say is, this is possible for everyone. I'm not special, I'm not unique. I currently own over 70 rentals, always actively adding to them. I've done over 100 transactions, which includes wholesaling and bird dogging. Talk about that real briefly. Overall real estate investment highlights. I own over $25 million of real estate. The cool part is I only started investing in 2020. So I don't know where you're at in the journey, but it's very possible to do a lot very quickly. An even cooler part than owning $25 million of real estate is once I hit around $3 million of real estate, I essentially had more money coming in every single month than I ever needed to spend. So I was financially free very early in my journey, and I just continue to build on that. Once you develop the skill sets, it's almost dumb not to continue growing in skills. That's it. The main thing that I also do is co-living. I own in a dozen states, and I raise all the money to buy my real estate investing journey. The things I specialize in are co-living, creative finance, capital. So, very simply, I want to explain how you become financially free through real estate. I think people don't really think about this piece a lot, but real estate is incredible because it provides you lots of value. The most simplest way I can describe financial freedom through real estate is that you get monthly cash flow, you get income coming in from your properties that exceed your expenses, that profit is your cash flow. Once you have enough of that to cover your expenses, you're financially free. You no longer have to work, again, for someone else. You no longer have to ask the boss for time off. You no longer have to do anything like that, which is awesome, because then you can do whatever the hell you want with your life. Whether that is keep working or whatever you want to do. The other cool part about real estate is you don't just benefit from cash flow, you get appreciation. Properties go up in value over time. That adds to your net worth, that adds to your wealth. Your tenants are paying down your debts for you, so your properties are increasing in value. Your debts are going down because of what your tenants are paying. You keep the difference, that's your cash flow. And the cool part is the government allows us to keep all of our freaking real estate money. Thank you. I don't know why, but thank you for that. That's a massive cheat code of real estate investing. I always include the fifth piece, which is leverage, which real estate, there's a lot of leverage. You get to buy a $400,000 home for with a down payment of, let's say, 20%, or us creative financing. You know, you could put $30,000 to buy a $400,000 property. That's leverage. I get control of a $400,000 asset for $30,000. More importantly, as you get more knowledgeable and you develop your skills and your strategies and your relationships, you can also leverage other people's money to buy real estate. I have not used a single dollar of my own money to build my real estate portfolio. I built a $25 million portfolio through raising $7 million of other people's money. To put that into perspective, I have never made over $150,000 a year in the regular workforce. If I were to save $150,000 a year, so if I made that and saved it, it would have taken me over 40 years to have saved enough to be able to build my portfolio. Well, once you develop your skill sets, learn how to raise capital, and that takes you to the massive next level. My very short path to financial freedom. So in 2018 is when I started learning. So when I joined the military, and I just started learning about real estate investing. As I mentioned, I knew I wanted to be financially free. I knew I couldn't save my way to get there. I didn't really trust the stock market. It was going to take too long, so I started learning about real estate. I heard, Christian, you mentioned that you have analysis paralysis, or paralysis by analysis. Yeah, and that's very common. And that's probably the most common place people get stuck. They continue to learn and consume and do everything besides the thing that actually generates them returns, which is owning assets. And I say that as someone who was stuck in that for 2 years, and I had to give myself an ultimatum in May of 2020 after 2 years and hundreds of deals analyzed and joining meetups and all that kind of stuff. I had to give myself an ultimatum that the very next deal that made sense on a spreadsheet, I was going to put an offer in. It sounds obvious now, like, yeah, you have to put in offers to buy deals, but when you're stuck in the thick of it, you're just analyzing and you can't, like, I just felt like I'm doing all the work, but I'm not owning real estate. Well, I realized I'm not putting in the freaking offers. I'm not taking the next logical step. So education's great, but you have to actually complement that with action. Otherwise, you're going to get no results, right? Like, you got to get out of the education phase, and the best way to do that is you got to get educated to start off, and then build your network, connect with other people that are doing the thing that you want to be doing. That's what changed it for me, and I forced myself to take the next step. So I bought a 2-unit property using my VA loan. My wife and I lived in 1 unit, and we rented out the other unit. And so we house that. So we lived in 1 unit and rented out the other unit, and that was great. I got the confidence to buy a deal. We were living rent-free. Once we moved out, we'd make $1,000 a month. It was incredible. And at that point, I said, I'm going to buy 5 properties in 5 years that are going to be small multifamily. Every single year, my wife and I will move to another 2, 3, or 4 unit property using the low down payment option because I understood traditional financing only at that point. And then I said, well, I'm going to start learning from other investors because I have to wait 1 full year to buy my next property. So I started bird dogging. Very simply, bird dogging is finding deals for someone else and then getting paid to buy those deals, or getting paid to sell them those deals or connecting those deals. The best advice I can give you is bird dogging is a phenomenal strategy if your goal is to learn and build your confidence, because especially if you are doing deals for someone you want to be like, right? If someone is doing deals the way that you want to do it in the future, the best thing you can do is find them deals and get paid for it. You're earning while you're learning, and more importantly, that person you want to be like just paid you a fee on top of the deal that they paid the fee for to buy. So it's like even more confidence that someone just paid you to buy that deal. That should really build your confidence. It was exactly what I did, and it helped me make massive progress on things that I was uncomfortable with, which was out-of-state investing. It was creative finance. It was doing remote fix and flips. The idea at that point was to do bird deals. So then the next year I bought another small multifamily property, a 4 unit. My wife and I lived in one, rented out the other 3, and then I started finding deals off market. I started leveraging the stuff I was learned as a bird dog to then find deals off market that I could sell or finance in my local area. At that point, I bought 20 rental cabins, seller financing. It was more than I think we're not going to get in the weeds of that. And at that point, at 26, 27 years old, I never had to work again. I had more money coming in from real estate than I was spending every single month. That's cool. Like, most people stop there. You buy one property, you're ahead of the game. You buy a couple of these things, you're generating $3,000, $4,000, $5,000 a month in cash flow. For most people, you never have to work again. It's incredible. At that point, I invested more in my education. I joined Pace Morby's mentorship, right? Sub 2, a lot of us are in. And I started learning a lot more about creative financing, capital raising, and all that good stuff. And I bought $23 million more in the last 2 years, 2.5 years, using what I call my super investor blueprint. Very simple. Oh, cool. Very simply, the super investor blueprint, or what I call the cheat code, is combining co-living with creative financing and capital raising. It's literally, that's what I do. You want my secret? It's that. I buy co-living deals, I buy them creatively financed, and then I raise the capital, so I'm using none of my own money. I buy co-living because it allows me to maximize my wealth and my cash flow per deal, and there's a lot more co-living investment opportunities out there. I buy creatively financed deals because it's way more scalable than traditional financing, and I get to get way higher returns from buying them with lower down payments, lower interest rates, which also means I get to buy more properties. Capital raising, most people are stuck with how to finance a deal. Well, if you're learning the skill set of raising other people's money, money's never going to be your problem. To give you guys some practical advice on how you can build your own path to financial freedom, it really does become fairly simple if you really think about it. Your goal is to become financially free through real estate, which means you need real estate that is generating you cash flow that exceeds your monthly expenses. Well, what do you need to generate cash flow from real estate? You need to actually own the real estate, right? You need to actually buy the property. What do you need to buy the property? You need to put deals under contract. To put a deal under contract, you need to analyze those deals. To know what deals to analyze, you have to have a very clear buy box of what you are looking for. Well, that's what I'm giving you right here. Your path to financial freedom is really this straightforward. Clearly define your financial freedom. What is the dollar amount that you want to get to monthly? What is that cash flow you want to get to? And then tie it to your why. The coolest part about financial freedom is the personal finance component, which means everyone has different expectations of how much money they need in their life, what they're going to do with that money, what they want to do with their time once they're free, which is great. You got to set whatever that goal is. The best goal to set is what is your current expenses. You can offset your current expenses and not have to work 40 hours a week plus for that. That'd be a pretty sick position to be in. Even if you can generate $1,000 more a month passively and build wealth through real estate, that's a pretty sick place to be in. And setting your financial freedom goal and defining it, tying it to your why is the foundational start. That's what's going to help push you through those harder moments where you're like, why do I keep doing this stuff and not getting the results that I want? Because sometimes that's the way real estate works. It's just a lot of effort and not always the results you want. Okay, cool. You got your goal. What is your investment strategy? What strategy do you align with that will allow you to achieve your goals more, that will allow you to achieve your goals? And you got to make sure it's in alignment and it's intentional. A lot of people are constantly chasing shiny objects. They see this challenge, this Zoom, and now they're doing RV parks, and businesses, and car washes, and all this other shit, instead of the thing that they said they wanted to do, and you will never make you can choose any of those, and you'll be successful. You have to choose it, and then stick with it long enough to get the results. Every time you're pivoting, you are restarting. You're like restarting from zero every single time, and then you're burnt out after 6 months because you have no results. You've been working pretty hard on 6 different things. It's like, choose something and stick with it long enough to get some results. That's probably the best piece of advice I can give. Then, once you choose your investment strategy, identify the markets that work for your strategy. For example, I do co-living. I will show you exactly how I choose markets that work well for co-living. Other people do like short-term rentals. So where are great places that short-term rentals exist? Where are great vacation rental destinations? You have to make sure that where you're trying to buy is in alignment with your investment strategy. Well, okay, we're moving down the funnel, right? Your goals, your investment strategy, what markets work for that strategy. Okay, now what are the ideal property characteristics? What are you looking for in a property so that you have, at this point, you have a clear buy box? You know your strategy. I'm doing co-living. I'm buying primarily in the Southeast, primarily in Georgia, in Florida, in Tennessee, in North Carolina, and I'm buying in major cities only. Great, and I'm primarily looking for properties that are no less than 3 bedrooms.
Are you buying in California?
I own in California.
I have a house in California, you can have.
I mean, I own plenty of properties in California, but for most people,
perfect house because it allows 8 additional dwelling units.
oh, that's cool.
And it gives you up to 18 units on this land.
Is that like frozen?
It's Sacramento.
Oh, yeah. Sacramento is great for co-living because their government is giving
Watch
grants.
Bird Dog.
Let's do it.
So then, once you have your market, and then we're talking about property characteristics, I'm looking for 3 beds, 2 bath, or larger, 2,000 square feet. So now you can tell someone to bring you opportunities, or you are specifically looking for opportunities that are in alignment with what you're looking for. People spend so much time and energy looking at things that are not actually going to be potential deals for them. So that's why we're going like linearly in this path. Luckily for you guys, if you want to do co-living, I'm just going to give you all that stuff throughout this presentation. Then your next step, analyze deals. Don't get stuck in deal analysis, but you have to analyze deals because if you analyze deals, you are building your skills, you are building your network, and you're building your confidence. The point of analyzing deals is to find deals that you want to buy, but during that process, you're going to build so much skills. Every time you get a quote from a contractor, you're going to get more knowledgeable about the anticipated costs for renovations. Every time you talk to cleaners and property managers, you're getting more knowledgeable about your markets, the properties that you want to buy. And then at that point, you just constantly build and scale your portfolio because you know exactly what you're looking for. A little more simple than easy. It's definitely not easy. The majority of people will fail in every part of this because they will get distracted by shiny objects. They'll waste time looking at deals that would never make sense for them, but they're spending their time. They are they're buying the wrong properties or in the wrong areas for the strategy they want to implement, or they're just giving up on deal analysis and just buying deals that are not actually pushing them forward with their financial freedom. So it's simple, but it's not easy to do this stuff consistently and long enough to get the results. All right, so what is co-living investing? Very simple. You buy a property and you rent it out by the room. You could buy a 4-bedroom, 3-bath property and rent it out by the room. Or you could do what I do, which is where I buy a property that has more square footage and common areas. I convert those common areas into bedrooms and then rent that out. That same 4-bedroom, 3-bath with a living room, a dining room, and an office is now a 7-bed, 3-bath for me that I rent out by the room. Very simple. Buy a property, rent it out by the room instead of renting out the whole house. You rent them out as furnished rentals. It doesn't have to be fully furnished. It's not a short-term rental, right? It's not a luxury vacation stay, but you want to furnish the common areas and the bedrooms. The furnishing levels are very dependent on the market. Why invest in co-living? Well, I'm going to talk a little bit about the affordable housing crisis and why co-living is more important now than ever before, and it's only going to become more and more important. But at the end of the day, we're investors. We want to help solve problems, but we also want to make sure that we're doing things that are providing us solid returns, right? So as I mentioned, choose your investing strategy. We're choosing co-living because it's a great investment. It's great that we get to provide affordable housing. We're doing it because it's a great investment. So you get higher income than you would with a traditional rent, right? You're going to make, if you're renting out by the room, you're going to make significantly more income than you would as a long-term rent. You get lower vacancy because you get properties that instead of one tenant not paying that 4-bedroom, 3-bath house, you have multiple tenants that are paying. So if you have one non-paying or you have one vacancy, you're spreading that out, so at least you can cover your mortgage, your expenses. Maybe you don't make as much cash for that month, but at least it's not zero income. Affordable living for tenants. It's an awesome benefit. I cannot say any other strategy that I do is as beneficial for the economy, for the people in our country, as co-living. When I'm doing short-term rentals, I'm taking housing from locals to then provide vacation rentals that sit vacant 40–50% of the time so that people can have vacation. Well, it's great when you take co-living, you take a house that one family can live in, but now 8 different individuals can live in there and then have affordable housing because they're paying 30–40% less for rent, all utilities and everything included, than they would have otherwise. It's an awesome thing. It's an awesome benefit of co-living. And it's very accessible. Like, I think right now is the perfect time for anyone to start co-living because it's not that hard to learn in the grand scheme of things. It's there's so many opportunities out there because not many people know about it. And if you guys are in this room, understand credit financing, you can make your deals way better than the majority of people who are putting 25% down payments to buy properties at 8% interest rates, right? That kills most deals. So unaffordability and co-living forecast. So this chart right here basically is showing that median rents have gone up significantly more than household income. What that means is people are paying a larger percentage of their monthly income towards rent than ever before, and it's really not slowing down. This is until 2010. If you saw this thing now, or 2014, it's even worse. COVID made this problem way worse. Inflation made this problem way worse. Everything is way worse now financially for people than it was even before. A big reason for that is there's a massive shortage of homes and rentals. So there's literally not enough housing available for people that want to buy houses, people that want to rent houses. That competition drives prices up. That's America, right? That's supply and demand. That's just the way it works. Plus, housing prices have gone up significantly in 2020 they've gone up significantly since like 2011 but 2020 to 2022, prices went up like crazy, primarily because interest rates were so low, people needed to put their money in something. When people are putting their money in real estate, it's going up in value, interest rates go up, making houses now unaffordable. Their prices are higher, the interest rates are higher, they are even further limited to what they can buy. And then, yeah, as I mentioned, rising housing costs exceed wage growth. The one thing I really want you to understand is if you're a renter, you know that you have to, your rent cost, like you have to make 3 times as much income as the monthly rent, which makes it really hard for people to afford housing. If it's $1,500 a month rental, just for, let's say, a 1-bedroom in Atlanta, we'll say, you need $4,500 a month of income. I don't know what that is yearly. I think it's like $60,000 or something like that. 54, it's like $65,000 a year of income. $65,000 of yearly income is around $30 an hour income. So to afford a $15, well, that's a lot of math, just hear this piece. If you're trying to rent a place that is $1,500 a month, you're going to need to make $30 an hour. Well, the vast majority of people do not make $30 an hour. So we're able to provide them this housing that they otherwise would not qualify for. This is extremely important because, like, if you cannot afford a 1-bedroom, what is your option? To live in the streets? Like, what can you do if you cannot afford to live in a single-bedroom house? I want to say, yeah, like, let's give free housing, or like us investors that solve this problem. We can't really do that. What we can do is take housing and create more affordable options. Give them a 30–40% discount. Let them pay $800, $900, $1,000 a month for a shared space, private bedroom, utilities included, and now they can use that money to enjoy their life. And one core thing to understand about the co-living market is it's more common than you might think it is. I know we as investors have probably heard it more and more and more, but it's already, as of 2024, it was already an $8 billion market size. That is huge. That is not as big as like short-term rentals, which is $100 billion, but that shows you the potential growth, and short-term rentals are only going down in value, where co-living is only going to continue to grow because our economic issues only are getting worse. Like, I don't see it. I don't know if tariffs or inflation or any of that's helping you guys financially every month. And for us as investors, we're a little bit more privileged. It doesn't impact us as much, but think of everyone else. It is like destroying their buying power and their ability to live and survive. This is a solution this is a problem that's not going to get better. We can help provide, we can help be a resource as to that solution. And a big thing to note is that the compounded annual growth rate is 13.5% for the next 5 years. It's a lot of fluff, but what that means is that's a huge amount of growth. Compared to any other rental strategy, there's nothing else that is projected to grow as quickly as the co-living space. So it's already big enough that there is a lot of data, a lot of proof of concept, right? Because you don't want to be too early because it may not work. But it's early enough that there's still so much potential growth, but it's still big enough that you can feel confident doing these investments. Right now is the best time to get in because of the fact that, like I said, there's enough data to make you feel confident, but it's also, there's still so much room to grow. You don't want to be joining something when it's too late. My short-term rental people who bought them in 23, 24, you know what I'm talking about. Like, you don't want to catch the tail end of something. You want to be on the forefront, but you don't want to be the person who bought Bitcoin in 2009. You want to do it when it's more easy to do, and there's more data behind it. Cool. All right, and then co-living is a necessity because of finances, cost increases, shifting spending habits. For early investors, you get a massive advantage because we get to buy larger properties in bigger markets. So like that's co-living in general, as opposed to buying a rinky-dinky $80,000 property in Missouri to generate $100 a month of cash flow. You can buy a $400,000 property in Atlanta, Georgia that is not very hard to do, and you get more wealth because you're buying bigger properties in better markets, and these are bigger houses as well. You're generating $1,000+ a month of cash flow instead of stacking 10 long-term rentals. You get that and then some with one co-living rental. And there is less competition right now because we are earlier in the space. Obviously, I'm creating more competition, but I'm not worried about it. There's still such a huge market, and I want you all to succeed financially. This is the way I recommend that you do so. Cool. Just to put in perspective, one property that I own in Atlanta would rent for, well, at the time of this, would have rented for around $2,000 a month. When you account for maintenance, utilities, which there are none, as a long-term rental, and then a 10% management fee, we'd be left over with $1,600 a month. Net operating revenue. That's not profit. You got to subtract away the debt payment from that. So it'd actually be negative cash flowing at that point. As a co-living rental, this property was converted to a 7-bed, 3-bath that generates $65.50 a month. You have maintenance. You're setting aside a larger maintenance dollar amount, even though it's a lower percentage because the income's so much higher. It's a larger dollar amount. You're covering utilities, and your management fee is more expensive because it's a higher percentage of a higher dollar amount, but you're still left over with significantly more operating revenue. This property that would have lost $100 or $200 a month as a long-term rental generates me almost $2,000 a month as a co-living rental. You stack 1, 2, 3, 4, maybe 5 of those, how's your life looking at that point? And this is even cooler because this is low interest rate seller finance, less than 10% down payment, so it's even easier and more accessible to get into. Once again, this is one example. I'm not saying every co-living deal is like that. This is one of my properties. All right, so why is co-living the best rental strategy for single-family homes? Way higher cash flow, 2 to 20 times the cash flow that you would get on a long-term rental, or even in that example, negative cash flow, now you're generating $1,000 a month. Higher appreciation because you're buying bigger properties in better markets. They're increasing in value more quickly because those markets are appreciating more. Like some random town in Missouri is not appreciating in value the same as Atlanta, Georgia. Higher debt pay down because you're buying bigger properties that have larger debts. You're paying down those debts more quickly, and they're larger debts that are getting paid down, so larger dollar amounts. And because the properties are worth more and you're renovating them, there's more tax benefits. So you take a same long-term rental and you get way higher returns every single way that you look at it. And then the bonus benefits, like I said, I'm an investor first and foremost. I'm telling you guys about co-living, not because I'm trying to solve the affordable housing crisis. I'm telling you about co-living because I want you guys to be financially free. A bonus is that we get to help other people afford housing that they otherwise would not have been able to, and now they can save and invest, or like what most people do, they're going to save and then spend that, but good, let them. Instead of spending on housing, they can go travel, eat out, do whatever they want with their life, enjoy it more than just spending on rent. You work all freaking day to then pay most of your money to rent, healthcare, car payments, gas, and it's like, what do I got left over? Well, a lot of people want to pay less so that they can enjoy their life instead, and I'm all for that. Right now, there's way less competition, and it's way more accessible because there's just less people that are doing it. A lot of the people in the traditional world have not adapted. Those who combine it with creative financing have an even larger advantage, and it's way easier to find property service providers in co-living markets than it is in the small market. Like I keep saying the small town in Missouri, but like if there's, I own in Fairbanks, Alaska, 30,000 population. It's where I started my military. That's where I was at the military, where I started my first investment property. There's like 3 property managers. I've had to fire 2. I'm down to my last one. And they can charge whatever they want because there's just less competition. When every property that I'm buying in Atlanta, there are hundreds of cleaners, hundreds of plumbers, like dozens, if not hundreds of property managers. It is easier to do business in bigger markets than it is in tiny markets. That's just a fact. I'm not going to push that anymore. Then the super investor cheat code is combining co-living with creative financing, so you're getting more deals that work at lower entry costs, so you can buy more properties. You're increasing your cash flow. Buying something at 3% interest instead of 7% interest is saving you hundreds of dollars a month, if not 1,000 plus, in interest payments, building more cash flow, paying down your debts faster, and you're building equity faster at these lower rates. I already gave you everything for co-living. Cool. So the next part of the funnel, I have hopefully shown you that co-living is a phenomenal strategy that you should consider implementing. How do you choose your co-living market? You need to focus on markets that are unaffordable. There's no point in providing affordable housing to markets that don't need affordable housing, right? I'm not going to buy a co-living in that small town in Missouri. It doesn't make sense when you can rent a single-family home for $600 or whatever. It just doesn't make sense. So you need to, how do you find markets that are unaffordable? Compare studio or one-bedroom rents to salaries. So if people are making $50,000 a year, that's like $25 an hour. How am I going to do this math? Whatever. Just compare salaries to rental incomes in that market. If people are making significantly more or rents are so low, are we good? Oh, I was going to say, but I got too much more left.
Don't worry.
Just 3 more minutes.
It's kind of moisty in here.
It is moist.
Put water on the other side of this like wall.
You're doing intermission now.
There's water on the other side of this wall, so in case you guys need some water, just letting you know. Okay.
All right, so you're going to compare rents to the average salaries. You want to make sure that the rents are pretty high compared to the average salary. And when I'm talking about the average salary, the majority of, like, if you think of the median household income, it's around $80,000 for a house. That's $40 an hour. So that means 50% of households are making less than that. And that's households, not individuals. So compare individual income compared to rents. If rents are really high compared to salaries, it's probably an unaffordable market. There's a ton of markets that have salaries that are on average less than $60,000. Once again, that's that $30 an hour, right? That $15 to $30 an hour space are the people that primarily need affordable housing. Co-living does not work well in low-cost markets, and there's a ton of people that are lower income workers. And I say lower income, I'm not talking about minimum wage. I'm talking about $15 to $30 an hour is still below the median, and they cannot afford housing. As if you're making less than $60,000, you cannot afford $1,500 of rent. Most landlords will deny you immediately. Major, yeah.
Favorable occupancy laws.
I got you.
So I bought a house in Mesa, and I'm converting it into a 13-bedroom. Right? At the same time, the 4-bed, 1-bath, 1-bed, 4-bed, 2-bath, in a 1-bed, 1-bath, 8-bath.
Okay.
I was converting it into 13 beds, 5 baths. Right? It's going to be $250,000 project.
Yeah.
Well, at the same time, I was hearing like 2 different people, one in the community and then someone else outside, saying that Mesa was cracking down on co-living. And so I kind of was like, well, I'm not going to, Duran was the one that I sat with, and even when I was talking the first time, he was like, dude, if the laws come down crashing on you, this 13 bedrooms can be something that you can get out of, right? So that's why I'm like, okay, well, 8 bedrooms maybe a little better.
Yeah.
My question to you is, how do you look past the fact, because some of these people are going to be investing into converting 8 bedrooms, 10 bedrooms,
Right.
which is not common for a house to sell in the market,
Right.
right? So how do you, in this case, I invested $30,000 worth of holding costs and $9,000 worth of planning to find out that I could be affected into something later down the road that I was going to invest the rest of the equity. So how do you investigate occupancy laws in an event of a co-living?
So most areas are going to have occupancy laws that limit co-living. And what do I mean by that? They're going to say that you cannot have more than 4 or 6 people that are not of the same family living in the same house. So that's like what an occupancy law is. How many people can live in the same house that are not part of the same family? So a lot of them will have that. Some states, some cities are rescinding that. For example, Denver, Colorado said, we don't care. So make sure you're following good building standards. You're following, like you're just providing, like you got the 2 egress windows and all that stuff. We don't care how many people are in there, as long as the house is safe and it's good for those people. A lot of them will also have occupancy laws. They have not removed it, but they look a blind eye to it. For example, Atlanta. Like Atlanta's one of those where there's so much co-living and there's still tons of demand for it nonetheless. And they will have occupancy laws, they just will not enforce it because they understand the net benefit is far greater than the downside. How do you prevent getting cracked down on? Make sure you're taking care of your property as much as possible and you're buying them in such a way that it makes sense for the tenants, for the local laws, and for your neighbors. So I would never do 13 bedrooms. I pretty much love the space of 6 to 10 bedrooms. Really, it's that 7 and 8 is kind of where I thrive primarily because you can create very comfortable 7 to 8 bedroom houses. You have sufficient parking for the properties that we're buying. Like, we're not trying to exceed the like a reasonable accommodations for people in that house. If you have huge square footage, it could work. But when you have 10 plus bedrooms, there's a lot of risk that neighbors will be upset. The city will crack down on that. They'll enforce your bill. They'll look at like your permits and all that stuff to see like what is going on. I primarily don't do what you're doing. I don't do full gut renovations. I don't think it's necessary. I don't do like major renovations to my properties. I'll get into what I do, which is primarily buying property and converting common areas, a living room, a dining room, an office, into another bedroom. The reason for that is, first of all, my renovation costs are extremely low. My carrying costs, so the amount of money I have to spend to do those renovations, are also extremely low. So it's done very quickly. You technically need to permit like everything you do in a house. I don't permit that kind of work because I'm not structurally changing the house. I'm adding walls and doors where there weren't before, but I'm not like removing walls. I'm not removing windows. I'm not doing anything huge that's degrading the quality of the structure. So I'm doing things that are minimal, and the massive benefit of that is it's also much easier and lower cost to get rid of that. So I would not buy or build, like I know people that do brand new builds. They're designing houses that are 10 bedrooms, 10 bath, that they're going to keep as co-living. You got to plan that you're going to keep that thing for as long as possible because you're going to have a very hard time selling that on the retail market to someone else who is not an investor. The people that pay the most for a house are people that want to live in it. So I always buy my properties and convert them over so that I know that I can easily convert them back at low cost to then sell at the highest dollar to people who want to then live in it eventually. That is how I do it, and that minimizes a lot of those concerns. So I'm not over exceeding the number of rooms I put into a house. I'm being very cognizant of the neighborhood and the parking space and all that, so I'm not triggering any concerns with my neighbors. I'm not triggering concerns with the county. I'm not doing things that require permitting, in my opinion, because like I said, everything requires permitting. So local jurisdiction people, like, whatever. I know you need to get, but there's like lots of silly things that need to get permitted. Like, some of you paint too much, you might have to permit that. So, well, I live in California, so we're really crazy about it. With that being said, that is what I do. And I always think with the exit in mind. Because that wealth, that appreciation, that pay down is meaningless if you cannot sell your house at a much higher value. The best way to sell that is as a regular house to someone who's willing to. The person who loves the kitchen is going to pay you a lot more than an investment, right? So I'm always thinking of how can I efficiently get into my deals, how can I efficiently get them back to sell at the highest possible value. And I'm never exceeding. I just did a 2-day co-living workshop, and I told people, on the spreadsheet, it will always tell you it is better to add more rooms. It is always better to add more rooms, but that's not the reality. Just because the spreadsheet says that you should add another 3-4 bedrooms, there's a lot of issues that could come with that as well. So you can't just follow spreadsheet math, which is ironic for most people that know me as someone who analyzes a bunch of deals and gives away a bunch of calculators and all that good stuff. But the spreadsheet will tell you it's better to add more houses or more rooms. For me, it's managing quality of life and easy management operations maintenance, because that allows me to then scale. I don't want to spend too much time and energy on one house when I get to spend that buying 3 more houses instead. So that's the gist of that answer. Cool. Major metro areas are preferred, so bigger cities. And then favorite occupancy laws. So look into those. I'll give you the cheat code for how you know. The ultimate cheat code. There you go. PadSplit. I don't know if you guys have heard of PadSplit, but if you haven't, you need to utilize the platform PadSplit. I'm not saying you need to use them to manage your properties, but there are a ton They provide, PadSplit is to co-living what Airbnb is for short-term rentals. It is a place where tenants come and look for housing. You would not want to rent out a vacation rental through your own website. If you're going to use something like Airbnb or Verba or whatever, that's what PadSplit does. It helps you collect the income from the tenants. You lease your property, you PadSplit, not the individual members. Tenants, they pay a ton of money to build marketing, to build people that want to come and find affordable, rent by the room housing, and then you handle all the guest communications, income, all that through there. You don't. That's the service you pay for, and you pay for that through the income that you collect. They take a fee. The service that they provide that is head and shoulders above that service is all this free data on co-living. They're quite literally showing you a map of everywhere that is a core market for them for rent by the room. Their core market means they've spent a bunch of money marketing to tenants in that community to come and look for affordable housing. So they're spending a bunch of marketing dollars to do that. And then emerging are markets that there might be a few properties pending that will come, and then it's going to be a growing market. This map is quite literally telling you where you should do co-living, right? And then you can further research this map city by city to see which ones are the best markets, the best cities to actually invest in. I would not invest or try to do co-living in markets that are not on PadSplit. Once again, I think Mesa might be on here. I don't know where Mesa is, but is it just Phoenix? Whatever. So it might be that, right? And then just you can click. Well, I'll show you on the next slide. So once you click, so we click Atlanta, right here. I clicked. Where's Georgia? Atlanta. Actually, so this is me right here. So I don't recommend people who are not experienced try to do co-living in markets that don't have co-living. When I started doing co-living a couple years ago, PadSplit did not have a map that looked like this. PadSplit had a few little blue dots, Atlanta being where they started. So we were the first property in Port Charlotte, Florida, and we did something similar in Savannah, Georgia, and we actually are the first property in Savannah, Georgia through PadSplit. I'll be honest with you, we had a very hard time. We thought we got systems, we know how to do this, and we have done it pretty successfully before, but we had a very hard time finding great rent by the room tenants in Savannah, Georgia. We said, hey PadSplit, we do a lot of business with you guys. We need you to start spending marketing dollars in Savannah, Georgia, and within 30 days, we filled up all 10 rooms of this house because they started funneling their marketing dollars. Don't do what I do. Don't try to be a trendsetter. Go where the market's already at. Even as someone who's experienced with me, with team members and all that, we still, reality is in the face. We said, PadSplit, we need you to do your thing. The best thing about this map is it's showing you where other people are investing, and it shows you specifically the amount of units available. I'll go right back, I promise. And it's a good sign that if PadSplit has a lot of properties in that market, and that they're also spending a bunch of money in that market, that's probably a favorable market for co-living. Does that make sense? Because they're spending, it's the Starbucks or Chick-fil-A effect that people talk about for real estate. Like, if Starbucks did all this market research to tell me there's a good area that they want to create Starbucks, I want to buy a house around there. It's the same thing with PadSplit. If they're telling me they're spending marketing dollars for co-living rentals in these areas, okay, good. I want to work in those markets. I'm not going to go buy and try to be a trend center anywhere else. Although I do, but don't do what I do. Like, especially for starting out, right? Like, don't put that much risk. I have a big portfolio. I can handle it and weather the risk. There you go. All right. So this QR code will give you free access to that map and this map, all the tools on PadSplit. It's just that you can create a free host account. All you do is create it and you get access to all the hosting resources. It's a lot more than these maps, and these maps, it also connects you to my representative at PadSplit that I've used for the last couple of years, who was also a PadSplit investor, was working with me for a couple of years, and you get to get on a consultation call with her. She will learn who you are and then help you when you buy deals. Here's the kind of example, like data they will give. They will tell you quite literally how many active units are in that market. How many are upcoming? So active units are the number of bedrooms. How many bedrooms are currently available in that, are currently, available is not the right word. How many units are currently in that market? They're not available. Most of those are rented out. How many are upcoming? So 196 rooms are upcoming. The demand in the last 30 days, 39,179 unique people, different people, searched on this platform in this market for a co-living rental. A lot of people, and this is the way I used to explain this as well, you want a big demand. When you're looking at PadSplit data, you want a very big demand between the amount of people that are searching for housing versus the amount of units available. A crazy thing that I've discovered is that this is disingenuous. It's not just the demand of searches in the last 30 days. This is unique searches. So if I've looked 50 times, I'm counted as one time here in the last 30 days. But more importantly, of this, let's say 7,500 units, 89% of those are occupied. So it's not that 39,000 people are looking for 7,500 units. Most of these are already occupied. It's around 10% of those are available, right? So there's 39,000 people looking for 750 units. That is an insane spread of supply and demand. That, like when people say, oh, Atlanta's saturated, why do you keep buying Atlanta? It's the original market. They already have 7,500 units. Yeah, and there's still way more demand. It's only going to increase over the next several years. I honestly don't know, besides building more, and if the cost of everything is more expensive to build, and labor is not, I mean, now that we've lost, well, labor is more expensive now than it's ever been. Things are only going to get more expensive. So, I don't know, building's not really the solution either. Most builders are not building houses like they're building for people who pay more money, I guess. They tell you the weekly room prices. So, like on average, what do you get? What income do you generate if the tenants are sharing a bathroom? What about those that have a private bathroom? The average occupancy. So how many of the rooms available are currently rented out, right? Or the opposite of that is the vacancy. 100% minus 89% means that average occupancy is vacancy is 11%. 11% of the rooms are vacant. For my real estate investor out there, you understand vacancy percentage is a huge one when it comes to analyzing deals. That's how you get it through PadSplit. And how long it takes on average to get your first booking, and then how long it takes on average to get 80% of the house booked out. The cool part is this map, I don't even show you. If you click any of these, these are all zip codes. You click on this, you'll get the same data, but specifically for that zip code. So you get more granular data. If you're looking at a property, it doesn't matter what Atlanta is at the grand scheme of things. This is how you choose that Atlanta is a good market for you to invest in. But then when you're analyzing a deal, you're choosing, like College Park, I love my College Park properties. Those things are like 100% occupancy. They're like always rented and above these numbers. Everything is better in College Park than these numbers. So when you're analyzing the deals, you can look at it zip code by zip code. If you use my link, you get to connect with Blake, and she is, I don't know, one of the few, but she's definitely one of the people there. When I say, hey Blake, I'm trying to buy a property in College Park, here's the data that I have, I want to know every other property around it. I want to know how occupied are they. I want to know what they look like. I want to know what they're renting for. Because, well, yeah, that's even more granular data. This is how I minimize my risk, is getting really good with the data that I'm collecting. PadSplit is that cheat code, even if you never actually use them for management. Cool. Everyone got the QR code? You're good? Cool. Ideal, right? So we talked market. Now we're talking property characteristics. What makes a great co-living investment? Well, first and foremost is location. Like I said, the market is the most important thing. Don't try to do co-living in a place that does not need affordable housing. More so, it's also the sub-market. You're in that state. What about the cities? What cities make sense? Do it where it's needed. Property size is the big one. I want to have, I will not buy a co-living rental that is not 6 or more bedrooms. I prefer 7 or 8 bedrooms. Typically, I'm not buying 6, 7, 8 bedroom houses. I'm looking for properties that are 3 bedroom, 2 bath. I put 2,000 square feet, but I'm cool with 1,750 square feet or larger. These are minimums, so that I can convert those into bedrooms. My ideal, 4+ bedrooms, 3+ bathrooms, 2,000+ square feet in a major market, right? That's my ideal, what I'm looking for. I like lower cost conversions. I'm not trying to do a full, I'm not a fix and flip. Well, I fix and flip, I'm not a fix and flip. I'm not trying to do that, especially remotely. What I am doing is I'm converting rooms that are super easy to convert. I am taking a living room and I'm adding walls and a door. I'm taking an office and putting a door and a closet. I'm taking a finished basement, even an unfinished basement, and I'm converting that into bedrooms. I'm not doing full renovations. I'm not adding a bunch of bathrooms. That's why having a couple bathrooms is key. Don't buy a 5-bed, 1-bath. I mean, that'd be a terrible house. But like, bathrooms are way more expensive, way more time consuming. If you're doing bathroom renovations, you should get that permitted, in my opinion. Not renovations, but if you're adding bathrooms, get that permitted. It's reflecting the septic. That could cause a lot of issues for people. I'm looking for properties that have solid parking. Parking is a huge thing for your tenants and for your neighbors. You don't want them parking all up and down your neighbor's area. So make sure it's got a good driveway. Corner lots are great, especially when you have, two sides, if they have long driveways. Some properties are really wide, so they have like a lot of parking in front. You want to make sure, because that would be an issue. A lot of properties that have a lot of turnover, a lot of problems, are those that do not have adequate parking for their tenants. I don't want properties that have an HOA or any rental restrictions. If my man Chino's here, he buys properties with HOAs, and he makes it work. I'm not trying to, my goal with all of my real estate investing is how can I buy more great deals, not how can I spend more time and energy on one property, right? Like, that's the reason why I don't manage my own properties. That's the reason why I'm not buying with HOAs. That's why I'm not doing these huge renovations. I'd rather spend that same time and energy raising more money, buying more deals, than trying to deal with an extra headache on one property. So I just minimize the things that cause headaches, which HOAs can add a huge headache, even if initially it may not seem that way. And then minimal enforcement or no occupancy laws, right? Like I said, most places have occupancy laws. Some states have removed them because they know it's a need and it's only going to continue to grow. A lot of them don't enforce them, right? As long as you're providing adequate, like, you're providing solid rooms, right? Like, when I say don't get it permitted, well, I'm not telling you don't get it permitted, but I don't get it permitted. What I'm saying is, even though you don't go through the process of getting it permitted, do everything that you need to, that you would need to if it was to get permitted. Don't build a bedroom that does not have 2 points of entry, right? You need a door and a window, and that window needs to be an egress window. So make sure you are doing things that are logical and safe for your tenants. The worst thing you could do is try to make some money by putting in an extra bedroom that's unsafe and someone gets hurt or unfortunately passes away in your house. I mean, that's like the most devastating thing you could do as a human being, and then financially as well. That was a very short-sighted financial decision for you. So do things, protect your tenants, protect your properties, protect your family and your net worth and all the stuff that you're building as well by taking care of your properties and your tenants. All right, property renovations are a must. Like I said, I'm not buying properties that are 8-bedroom, 3-bath. That's probably really expensive, and I don't know where those exist in major cities a lot of the time. My goal is to maximize my return on investment while having a minimal impact on quality of life on my tenants. That is what I'm saying, spreadsheet math. Don't get hooked into the idea that, oh, I think I could add another 3 bedrooms. That'll make me an extra $2,000 a month. But what you're not accounting for is, first of all, it's probably not going to be safe. You're probably going to deal with more laws and enforcement. Your tenants are going to probably turn over more quickly because there's too many people, or too many people are sharing a bathroom, all that stuff. Maximize your income, but also think about your tenants that are going to live there. The cool part about CoLiving is we're already making significantly more and more cash flow, higher cash returns, and it's much more stable than like a short-term rental. So be a good steward of the money that you're making and take care of your tenants. Don't just get stuck in slumlord spreadsheet math. That's the advice I give you right here. I've said it like 8 times, so I got a lot of great advice. Ideally, I want properties that are larger square footage, that have an ideal floor plan. I've seen properties that have 2,400 square feet. There's one right now that I'm looking at. It's like 4-bedroom, 4-bath, 2,400 square feet. But the way it's laid out, I can barely add an extra bedroom or 2. And that sucks. Thankfully, it's in Denver, so that works really well for the 1-bed one. That's a good market for that. But just because it's a lot of square footage does not mean it's an ideal floor plan to convert over to CoLiving. So ideally, you want rooms that are easy to convert. When there's living rooms, you can keep a living room, keep one living room, right? You keep the kitchen. But dining rooms, offices, garages, all those are great. And what I'm doing is I'm adding non-load-bearing walls, a little bit of electrical, so they have outlets and light switches, and then I'm either putting in permanent or pop-up closets. They don't need a drywall, full-build closet. Give them a really nice armoire for, it's going to cost you at least $1,000, if not more, to build that closet. Put in $200 to get them a really nice wardrobe set instead. They're going to be more than thankful for that. It's not going to be a bedroom if you were to sell that property, but no one's going to buy your 8-bed, 3-bath house anyway, with no dining room and all that. You're going to have to convert it back anyway, so make it easier to convert it back and your renovations up front. The 4-to-1 ratio is a bedroom to bathroom ratio. PadSplit does not allow you to have more than 4 people share 1 bathroom. That's great. However, 3-bedroom to 1 bathroom is even better. Our properties that are 8-bedroom, 2-bath from when I early started out, because that was the rules with PadSplit, those are terrible. Those are way worse. And they generate lower income, they more turnover, and turnover is one of the biggest expenses when it comes to CoLiving. Tenants moving out, the costs associated with that, the vacancies associated with that, it's better to keep great long-term tenants, have one less bedroom, less people sharing bathrooms than it is to constantly have turnover. Because people will stay there for a long period of time if you provide them a great experience. And they're saving money, right? Ideally, my goal is that they all save money, they invest it, and then they're able to go buy their own house. That's my goal for them. I know that's not the reality for the majority of people.
With the turnover you mentioned, and you also mentioned something about furnished, is it better to have something like that furnished that people can just move into with their belongings and then move out of? And then back to the closet thing, are you saying it's better to build a closet or it's better to bring in all like something that has
If it's got a closet, great. If it doesn't have a closet, I don't build it anymore. Like, I don't do it because there's no reason, because it's going to cost me way less to put in a really nice wardrobe set, both to set it up and to take it down, and it's the quality of life for the tenant is not significantly impacted, whether it's a physical closet or something that you're putting in there. And it's more adjustable too, so they can adjust the flow of the room. Because like putting in a closet kind of sucks sometimes, because of the space, the door, all that stuff sucks, and the footprint required for a closet as opposed to a pop-up. So that
and then for like you're saying like
you need to have so you need to have furnished, like for PadSplit at least, you need to have furnished common areas, and you need to have at least partially furnished bedrooms. That means you need to have a bed with a mattress. You do not need to provide linens. You do not need to provide I think all you really need is a bed, a nightstand, a bed, a mattress, and an electrical source. I don't think you actually need more than that for PadSplit. I would not recommend that you do that. I try to provide a better product that is available in the marketplace. So what I do is I include nightstands and lamps. I include a desk with a chair if possible. I provide the linen set. Sometimes I provide towels to them. Sometimes I provide a shower caddy with some of the essentials when they move in, because I want them to stay longer and enjoy their experience. Setting the foundation right from the beginning saves you, like, when you do that kind of stuff, they're going to think about that, and they're going to say, yeah, I'm not going to complain about little things we're going to try to figure out on our own. You're just setting the right mindset as opposed to, this is freaking slumlord. Give me the bare minimum, not even a single picture in my room. I give them a lot of ability to customize their room, obviously. I mean, they're not painting my walls or anything like that, but I provide enough of the essentials so they're not moving heavy furniture and scratching my floors and all that stuff. And they can easily move in and out, essentially. So you have to furnish it. PadSplit requires very minimal bedroom furnishing, full common area furnishings, but I go above and beyond because that allows me to get, I get my rooms rented faster and typically at higher rents because I have a better product. Cool? It's cool. All right, so the cost to acquire co-living rentals. The cool thing is the majority of the cost to acquire a co-living rental are the same as just buying a house. Most of those, for those of you who understand creative finance, or maybe you don't, but down payment and cash the seller. Like you have to put in a down payment or give the seller some money to buy their house. If there's arrears or liens that you have to pay off to buy that house, creative finance people, you got to pay that off. If there's an agent or a wholesaler and they have commissions, you have to pay them. If there's closing costs associated with the property, you have to pay that. It doesn't matter if I use it as a long-term rental, mid-term rental, short-term rental, it doesn't matter what my strategy is, those costs are the same. Usually, these costs right here are the most expensive costs. The acquisition cost for a property is typically the most expensive, especially the way that I do co-living. The additional co-living costs are renovating, so converting those rooms into bedrooms, furnishing costs, so furnishing the common areas and those bedrooms. And then you're going to have additional property reserves because now you're going to renovate for a month, you're going to furnish for a month. If it takes you a month to furnish, there's something wrong. But then you're going to have to list it and get it rented out and filled up in a month. So you want reserves set aside for the whole period. People make a huge mistake and they don't account for, oh yeah, I'm going to make no income, but I still have to pay all these expenses for the next couple months. It's a little bit higher for co-living because you're going to renovate, furnish, and it's going to take a little bit longer to fill up. So the difference, you're going to renovate, furnish, and have a little bit extra reserves. The actual costs to acquire the property are essentially the same. The additional costs are there for co-living, right? That's pretty much the gist of it. It's not crazy, it's great. And the reason, and this is really, additional costs for co-living properties, well, there's additional monthly costs, right? When it's a long-term rental, we're not providing utilities, we're not doing services, we're not doing that kind of stuff. Well, when it's co-living, it's a furnished rental. It's just like a mid-term rental. It's just like a short-term rental. You have more expenses. You cover the utilities. You're definitely covering the utilities for 8 different people because those 8 different people are definitely not going to be splitting a water bill themselves, not successfully. So you cover all that. They get the benefit of having an all-in price and You cover those expenses and you get way more income as a result. Alright, so you have the fixed expenses, right? Your mortgage, taxes, insurance, that's all there. Typically, as a rental, including a rental that's co-living right by the room, it's going to be more insurance costs. It's not always $100 more a month. You got to get a quote for that. But that's a pretty good rule of thumb, as long as it's like a $300,000, $400,000, $500,000 a month property. You got utilities, water, sewer, gas, electric, garbage, internet, Wi-Fi. Sometimes you provide landscaping. The 120 could be monthly. Typically, that's like every other month or every quarter or seasonal, right? If you have snow, you got to account for that kind of stuff. You can ask one of your 8 tenants to do it, but that's probably not going to work out very well. House cleaning, you don't need to do that, but it's a nice benefit. If you're making way more income, it's a nice benefit to clean the common areas and the shared bathrooms once a month, once every 2 months, and get extra eyes on the property. Typically, we just layer that. If there's a move out, cool. We'll just get them to clean more during that day, and the cost for that cleaning is much less than the cost if they just went to go do that on their own. They're already turning a room, now they're also just cleaning some of the common areas. You're saving money and you're providing extra value to the whole common space. We're not doing like their dishes and all that, that's on them, they gotta be responsible. But we'll just do a general cleaning because no one's gonna clean my baseboards or check for dust and clean behind the oven.
You have house rules?
Yeah, definitely house rules. PadSplit even gives you this, so they give you a bunch of house rules that you can provide. Literally just a poster you can print out and provide. They actually recommend that you do that. I don't even do anything outside. I don't provide any additional house rules. Well, my asset manager might, so take it with a grain of salt. We primarily use PadSplit's house rules for our houses. You do not have to provide supplies, but I give you space to account for supplies. Primarily toilet paper, paper towels, hand soap, dish soap. You don't need to do trash bags. Trash bags you do. You can provide those. It's not $75 a month. I'm an overestimator typically when it comes to my expenses, because that means best case scenario, I'm making more money after we buy the deal than I originally projected. I mean, plus or minus $20 is not going to make or break this deal. But like, you don't have to provide that. But like, who's going to buy that is my thought process. It's not that hard for us to get that stuff shipped in bulk every once in a while and just ease the burden on our tenants and the responsibilities for them. Some of our properties, like sometimes people live there longer, they end up becoming like the house manager. They end up just being the one to do it, or they collect the money and they get it ordered. So things happen, your houses are different. But this is a great way to minimize unnecessary friction on the new properties that we're doing. We minimize it by providing some of these common supplies. And then there's management. So PadSplit, the platform requires, so their charge, I put here 12% of the total income, but in reality, they are 8% of the total income. And that's not management, that's to get the tenants, collect the income, maintenance, communication, that kind of stuff. They don't send the contractor, they just let the tenant let you know something needs to get done. They collect the income, you don't have to do the leases, so that's huge, they do that. But so it's 8% a month, but what they do is they collect 100% of the first 10 days. It's a lot of numbers, but like for the first month, right, they're gonna collect the first 10 days of income, they're gonna keep all of that. That's their marketing fee, they're gonna just keep that for the new tenant. And then it's 8% of the total income after that point. For a 9-month stay, that averages to around 12% of the total income, okay? If you have another property manager, depending on where you're doing it, some people charge as low. I mean, I know the Hunts down here, I don't know if they're still doing it, but I think they do it at like a really low rate. I don't know if it's a flat rate, low percentage. A lot of managers in core co-living markets, not in random, trying to do co-living somewhere new, but in core co-living markets will have discounted management if you're already using PadSplit. Some of them will charge you 15, 20, 25% without PadSplit, right? But they charge a significant discount because they're not finding the tenants, they're not doing the leases, they're saving a ton of time and effort. And for someone like me, well, never mind. I won't get into like scaling. We're not here for that right now. Some of them will charge a flat fee. Some of them will charge more than that, like 8%. Like it depends. These are just some numbers for you to work with that are fairly reasonable based on what my experience. You update this stuff for yourself. Vacancy, remember we talked about occupancy, 100% minus occupancy. That's your vacancy. Put that percentage in there. Maintenance and capital expenditures, 6% of the total income is a good rule of thumb. What you hear a lot of times is 10%. That's 10% of long-term rental. 10% of $2,000 is $200. 6% of $4,000 is, what is that? Someone do that now. 60. I don't know. It's more than what it is for the long-term rental at 10%. So even though the percentage is lower than 10, right? What it is for long-term rental, your income is typically so much higher that the 6% is also higher than your long-term rental maintenance and expense, maintenance and capex reserves. If it's not, definitely make sure that this is higher. The reality of it is, CapEx accounts for like your big like renovations. You're gonna have to replace that roof. Having more tenants in that house is not gonna mean you replace your roof faster. But you might have more plumbing issues, you might have more maintenance, you might have more things like that, but the major CapEx, that is those big expenses, won't be that much more frequent, if more frequent at all. So accounting for a higher for maintenance is great. You don't really need to worry about the roof being needed to replace any faster. Cool. And then your cash flow is great. Your cash flow is your income minus your expenses and your property management and your reserves, right? Is your cash flow. That is how much money you're making per month. Your cash on cash return is saying, let's take that income, multiply it by 12, so your annual income, divided by your entry cost, how much money it took you to buy, renovate, furnish, have reserves to your property. Now it's telling you how hard is your money working for you. How hard is this $114,000 working for you? Well, at $14.26 a month, it's working 14.7% cash on cash return. I'm not doing a full deal analysis training. If you guys want that, I'm going to give you resources to do that. I got tons of that. That's the gist of what you're going to get from me on deal analysis. I'm providing you guys access to my free creative and co-living calculator that you guys can get access to. You can do creative finance, you can do co-living. I mean, you can do traditional finance, you can do cash deals, you can do short-term rentals, mid-term rentals, long-term rentals, but it also has creative and co-living in there as well. You guys can grab a free copy of that using that link.
Is it email it or something? After you put in.
Yeah, you put in your email, it should email you. I don't know, I got an interviewer, I don't know what he does, but he makes that work. It should email it to you, and then it'll invite you to a free community that I have called Wealth of Real Estate Free School Community. I'll show you that right now. My free Wealth of Real Estate School Community has tons of free courses and trainings and other tools for you that teach you traditional real estate investing and deal analysis, creative real estate investing and deal analysis, my Financial Freedom Blueprint. I have my paid mentorship, Super Investors. I give away the whole first part of the series, which is all about personal finance, budget, net worth, financial freedom goals, like defining all that, because I think it's so important for everyone to do that. I just give that away to you guys, as well as all the tools and resources associated with that. Bird dogging, so if you think that you want to do co-living and you want to learn how to bird dog for proven co-living investors, I train you on the concept of bird dogging, and then the course runs you through how to do it specifically for co-living for people like me who are looking for deals like I am. And it's not just me, it's me and then the 60 plus super investors that are looking for deals, and I would love for people to learn while they earn, and then you get to build your credibility and your knowledge, and you get to get paid for it. I mean, it's pretty sick. And then co-living deal analysis, I break it down in more detail through a couple videos, and I go live every single week doing Q&A and deal analysis, all that good stuff. That's all in there. That's the end of this long training.